Hi guys, in this episode of Q3 earnings, we covered, of course, the top companies that performed well in Q3, highlights of the year regarding, of course, the Federal Reserve and central banks policy changes, as well as what to look out for towards the end of the year, that is the indices price correction, and of course, the crypto market and the bullish momentum that we are witnessing. Hope you learned something. Have yourself a lovely conversation. Hello guys, here again with a bullish banter. This time we are going global. I hope you learned one or two things from the state of Kenyan economy, and obviously we do still follow how everything is panning out. Other than that, I'm your host Jesse, of course joined by
Rufus Kamau here.
how are you
Happy to
doing?
join. I'm enjoying the flow, especially with what's currently happening in the markets. Happy that we are finally entering correction territory in the NASDAQ and currently following up on the earnings to see what's currently being reported for Q3.
Yeah, one of the most interesting pieces of earnings report was that it was Google Cloud Services revenue declining, and finally, as we close the year, the talk of AI is down. I was tired of hearing that word.
Well, it's lonely on the top for Microsoft. They have some good upbeat earnings, especially from their cloud services.
Yeah.
So for Microsoft, they are winning it big, but the other companies are not having it so rosy.
Okay.
Yeah.
Now, this year we have had a very high interest rate environment. I think for long-term investors, and I know a couple of clients at FXPesa would typically trade CFD stocks. They have been very major on the tech side and maybe a few of manufacturing. Unfortunately, with the work going on, they have also joined into the, remember we talked about some defense stock, which have really, I think they've performed well throughout the year, giving a return of almost 20 for those who hold it long term. What has been your highlight of the year? I know NVIDIA has been the standout, but I'm sure there are others within the, let's say the NASDAQ, first of all, which has performed better.
Well, the highlight of the year could be, I would say, Jim Cramer. The inverse Cramer index has been really something to think about. How could he get it so right for so long? Like every time he mentions a stock, it either goes down if it's bullish. If it's bearish, then it goes up. Yeah, that has been crazy. Also, the Senate, U.S. Senate members participating in the stock market. I remember, was it 1 month ago when they started buying defense stocks? Then eventually we didn't know what would happen in the Middle East. And now the defense stocks are currently running. So there have been quite a highlight with out of Senate members front running the entire stock market.
If I'm not wrong, there is a AI bot which basically tracks all positions or options traded. For those who are not familiar with options, I think we covered it with the Nderitu. And I think those are the people who have really sort of benefited, at least, from following what the decision makers or policy makers do with their money. So if you see somebody has a put option of almost $1 million, why should you do the opposite, right?
Definitely. This guy is in policy making, and he basically goes and buys, let's say, Raytheon. Then you don't have to think about it. You just go buy whatever he's buying.
Out of nowhere, you are very sure there is no policy research. There might be, not saying that there isn't, but it is very strange that you just cash out of something and put in something, and it's not like you're doing it for the long haul, or like 10 years or something like that. You're just getting in for the ride and then you're out immediately. You feel like the maximum has been hit. That's quite sort of interesting. I'm sure that I've seen there is a push to remove them from, obviously, of course, participating in the market, which can be hard. Because as well it's their right, but that is how it is. Anyway, let's start with the bond deals. I think they have been the talk of the town for the last almost a month, hitting the levels of 2007. Are you like me who who is tired, let's say, of comparing 207 synonymous with some crisis coming and more like a historical price level?
Personally, I've always viewed this particular event differently because we have technically had a decade of almost zero interest rates, meaning that money was manipulated real hard. Businesses that could never have survived in a high interest environment, they actually thrived within that period. Then comes the QE infinity. In full terms, is a quantitative easing infinity, where during COVID, the Federal Reserve Bank of the US decided to implement this policy where it would be buying an infinite, not an infinite, but there was no limit to how much bonds and mortgage-backed securities they would be buying off the markets. So by doing that, they literally printed over $8 trillion. And this has never happened before. So when you have zero interest rates and then over $8 trillion printed within a period of 2 years, then the overall impact is expected to be something that you have not seen before. So the sudden increase in inflation in the US up to the peak of 9.1% in July, followed by a period of time where interest rates were hiked at the fastest rate ever. So within a period of 18 months, interest rates moved from 0.1% to 5.5% currently. And normally, if this happened back in 2007 or any other period in time, this would lead the US economy straight into a recession. But then what you are seeing is the stock market being currently strong, NASDAQ having the best half-year record in history, S&P 500 doing really well, and Dow Jones basically swinging a pendulum around 0%. I think it has been one of those situations where this has never happened before, but since it has happened, then the outcome of this or the effect or impact of this on the economy is also expected to be something we have not seen before.
Maybe for those who are not familiar, why is it that a higher bond yields is bad for maybe things like NASDAQ or even the cash market or even the economy in general?
So generally, when you see bond yields rising higher and higher, it means that the appetite is high. Like the demand for those recently issued bonds is really high. And of course, investors are betting that in the near future, interest rates will continue to stay high. Because if you buy a bond and interest rates rise further, your bond loses value. Mm-hmm. So they are betting that interest rates will remain there or perhaps even move a little bit lower. Mm-hmm. So with that bet, it means that investors have two choices. You either go for riskier assets, such as stocks, real estate, and so on, or you go for the safer option. So if people are going for the safer option, that basically tells you that their outlook for the next couple of months or years is so dim that they don't want to invest in these equities. So that may explain why we are seeing the stock market having this really good performance, but the performance is not coming from all the S&P 500 stocks. It's only the Magnificent Seven.
Yeah.
So if you remove the performance of the top 7 companies in the S&P 500, then all the other companies are literally either down or flat.
Yeah. I heard from one of the fund managers is like, if I get within 3 months 4%, 5%, without doing anything, why should I bother researching about Tesla's growth revenue, sales targets, pricing of their models? You just put in and then you sit down and watch the government do its thing. So there is definitely that aspect of it which has been quite, simmering and going about on all the spaces of the finance.
Think about it this way. You're running a school and you are graduating 500 students every year. So out of your 500 students, only 7 guys are getting straight A's. Then the rest of 493 are basically averaging somewhere around D+ and C-. Now, someone is marketing this school to you. Would you take your kid there? Or would you buy a share in that school because they are having a good performance? So that's basically what's happening with the S&P 500. So investors are realizing that the majority of these companies are not really doing well. It's only a select number of companies. And that explains why the focus on the earnings this week has been on the Magnificent Seven, where 4 of the top 7 companies are reporting. We saw Microsoft do really well, beat earnings. Google was slightly up. We also saw which other company was
I think
reporting?
Google it dropped yesterday. That was 25th. By almost 9% in a day.
Yeah.
But I was like, it should not worry because it is up almost 50% year to date.
Yeah.
So I think it should not really be a cause to worry.
Yeah.
It is just a slight, maybe somebody is cashing out his investment and then he's done for the year and look for another juicy toad, as you put it. So
we are now looking at Meta platforms. It also showed some good performance last night. And now the remaining one is Amazon at the close of market today,
and of course
being Wednesday the 26th.
And the Big Apple.
The
Big Apple. What do you think? I saw Apple had already started issuing, guidance in the sense of they are looking to maybe for something else, maybe another, say a supplier for their products. Plus also other more products to cover the risk of them not hitting the expected sales of iPhone 15, which I think has been the talk of town, but not, let's say, good numbers in terms of sales so far, but we'll see how it performs, at least maybe by the Q4 results sometime next year.
Yeah, I think it's rapidly transitioning into a software company. Yes, the sales revenue from devices is good, similar to how Microsoft has had hardware, but then they fully depend on software and cloud solutions for the majority of their revenue.
Nice. Interest rate. I think yesterday we had Bank of Canada, and today, as we record this, I expect European Central Bank to maintain the same rate. Same thing I expect 1st of November. We have FOMC to maintain the same
Actually,
rate.
I expect the Fed to hike.
Wow.
Yeah. They have been passing this message for some good time, consistently saying that they need one more rate hike before the end of the year. And from what we have seen with Jerome Powell and other members such as Kashkari and so on, they've been saying it's better to hike now rather than wait and hike tomorrow.
Okay.
So there's a good chance if there's one more rate hike this year, it might be happening in the 1st of November rather than towards the end of the year.
Wow. Isn't that maybe superseded by the ongoing, global uncertainties? The bond yields are so high, and of course the markets are basically tanking down, at least correcting itself. I was going to say that I'm happy we are getting away from talking about central banks every time you want to do a trade. For those who engage in US markets, every time you want to follow, what is this central bank going to say? I wanted to shift away to something else, something, more technical and less dependent on what one person will speak at 9:30 p.m.
The thing is, from when this tightening cycle started, the Fed had a number of goals. We are hiking interest rates, and we want to do it fast to slow down the economy. Slowing down the economy means a couple of things. One, they want to see the GDP growth rate slow down. They want to see the job market softening. Basically, they want to see rising unemployment and lower wages. At the same time, they also want to see the housing market cool off. But then, from the data we had yesterday, the number of new home sales basically shot up. And if mortgages are currently at 8%, which is a record high, and more people are buying houses, means that there is still excess liquidity within the system. People have more money, they are buying more houses. The job market has not responded well. The unemployment rate in the US is very close to like a multi-decade lows, I think 40-year lows. Wage growth is still increasing, and inflation was the number one factor that was behaving quite well, having moved from 9.1% all the way down to 3%. But then from the last 3 months, we have seen 3.2%, then 3.6%, and now we could be headed even for 4%. So what this basically means is that the things that the Fed was looking to slow down are not actually slowing down. So seeing unemployment rate on the rise, and now fuel prices are becoming another factor, having rallied from around $71 to 3 months ago to the current rate, which is around $90, basically means that the economy is not slowing down, prices are skyrocketing, and it's hurting the economy. So looking at the current Fed rate cycle, considering those factors, there's a high likelihood that the Fed will keep pushing rates higher.
In line with employment, I think within the last 3 to 4 weeks, we have had the United Auto Workers on strike. And the General Motors released their earnings. They beat their estimates, but they removed the profit guidance. But from the CEO's message and interview on Bloomberg, he said that they are almost hopefully agreeing on a deal, and they want to make sure that every one of them is appreciated, in his words, for their good work and making one of the best line of cars that they are making. Do you think perhaps as we enter into Q4, we are in the Q4 anyway, this strike is likely to impact the NFP report, at least for the last month?
Well, yes, that's quite a large number of workers. So there's a likelihood it will affect the non-farm payrolls report next Friday.
Now that will be a problem for the Fed now, because they are trying to ensure maximum employment while also ensuring, because if they increase the wages as they are demanding 25%, that is not what the Fed wanted, because that was the issues. Because for them, you see, they are waiting for tomorrow's data on personal consumer expenditure, which is their best measure of inflation.
There's also this issue where if the Fed is looking to soften the job market and the job market is not softening, it creates this cycle where every company is looking to get and retain their best employees. So with the job market being this tight, it becomes a really competitive issue. And I think they have been trying to resolve this by allowing more immigrants into the country. But then, what we are seeing across board, for instance, the United Auto Workers, this is, I would say, a cohort of people where there's a large number of companies in the auto industry competing for this talent. So if the job market is tight and there's less and less people applying for these jobs, then it basically means that the only way that these companies can survive is by adjusting the prices to the upper side. And the overall effect is that if they adjust wages higher, then they have to also adjust their prices of their products, which basically creates this cycle of higher and higher inflation.
I think in Q2, we covered a lot about AI. Remember when NVIDIA was up almost 200? Their bird was launching, and then I think it was killed or something like that. There is obviously the ChatGPT, which they recently released, ChatGPT 4. Do you think as we head into, and then there have been the AI images of, Steve Harvey. Recently I've seen Drake with Michael Jackson on the stage and other things. Do you think AI, companies involved within that space, and as those who are trading, at least in the CFD space, should be looking for companies because I hear Amazon is also in the works to launch theirs, will still play a big role in company performance, especially either in revenue or their usage or even their price appreciation, or
Yes, definitely. AI products are basically helping companies to reduce their overheads. They're able to either process data faster and cheaper, or offer products better and more efficiently. Like the way we have seen, let's say Microsoft add AI to its search engine, add AI to its browser operating systems. So it's definitely helping these companies to lower their overheads, which basically increases their profit potential. So for instance, if you look at a company like Palantir, with the US government hiring and getting more deals from the company, and now there's geopolitical tensions. The US is using the software operations such as what's happening in Ukraine, what's happening in Middle East. It only creates higher and higher demand for these products, which basically creates value for the companies.
Maybe so. If you are looking to invest somewhere, perhaps globally, you might want to look for companies involved in the development, almost releasing the products, or those which have developed, and perhaps partnering with other, tech companies or global company services to provide such service.
I would focus more on the numbers. If a company has just, let's say, simply added AI to their product, how is that influencing the, let's say, sales revenue versus profitability? For instance, we saw a huge impact on Salesforce. The moment they integrated AI in their this software they use for sales, and they basically added AI, and the software got out of demand, and it increased their revenues, lowered their expenses, and now they are making more profits. So it's more about how does the addition of AI to this company manipulate or add value to its numbers.
True. It's like when, let's say, a joint invites a DJ, and
Yes.
the DJ doesn't lead to sales of
Exactly.
so yeah, it's very true. You must, the product you add should go down to some tangible factors of success. Now, bull market. We have had the longest bull market in the year. And do you think the bull market is over, or it's just taking a breather before we enter, the infamous Santa rally?
I think the bull market is technically over. It's over.
Really?
Yeah. Judging from what I am seeing with the top equity indices, the Nasdaq is down today 10.95% from its recent high in July. So whenever a stock market index is down more than 10%, it's officially in correction territory. Investors start thinking of that index as now going down. All hopes of moving up higher are basically benched.
For now, or at least for the foreseeable future?
For now.
For now.
Then there's the S&P 500, which is down what? I think 7.8%. So if by the end of the week it hits 10% down, then it enters correction territory, and we could also be seeing the same thing with the Dow Jones and maybe other indices.
This is even besides some of these companies that form the index performing better and everything.
Besides that, the European equity indices are also trading at 10-month lows. That is for the Eurostoxx or Euronext 50 cash index. You look at the French 40 index, they're all trading at those lows, and I think this could continue bleeding towards the end of the year as people realize that the inflation is not going anywhere, and central banks might continue tightening further into next year. So we had these hopes that maybe in early 2024 or mid-2024, we'd be seeing central banks cutting interest rates. But then from what we are seeing with the inflation numbers, the price of oil, then there's a high likelihood that we could be seeing elevated tightening.
Funny that 3 episodes later, the US is almost having their Congress speak, I guess. So you'll have to wait and see how that affects or builds confidence in the US economy.
The speaker was announced yesterday.
We'll see how he rolls. I'm bringing that because we are entering into the last, let's say, 2 months of the year, because December is usually the first, and then January 1st. You blink, you're up. What are you looking for to be the top companies, maybe, or in, let's say, plays in the market that any trader or any investor should be looking at? Of course, this doesn't amount to investment advice, but should be forming some interesting price action in the markets.
Well, first things first, USD JPY. For any forex trader, you must be looking at that. So USD JPY,
I'm looking at it, but I'm not touching it.
So we are seeing it hitting 150 with the Bank of Japan continuously threatening to basically support its currency. And such an intervention would see the currency pair drop downwards. But then, from the recent speech by Kazuo Ueda, the Bank of Japan governor, he's actually considering expanding the yield curve control from the current limit of 1% to 1.5%.
Maybe you could elaborate on that.
So what the Bank of Japan has been doing over the last couple of years is limiting the yields that are applied to their 10-year bonds. So by limiting those yields, it basically means that if yields are moving higher, then the bank becomes an open buyer for any bids in the market until the yields go down below the predetermined rate. So at the beginning of the year, the limit was 0.5%. So if yields are rising and they get to 0.5%, then the bank comes to the market and buys any bids that would push the yield higher. So in that case, it absorbs the demand and maintains the yields at that level. So then later on, they changed this, doubled to 0.5. It was 0.25, they doubled to 0.5%, then doubled again to 1% within the same year. So what this means is that whenever yields are approaching there, for instance, today they are at 0.88%. So as they approach 1%, they buy more and more bonds.
Okay.
So this basically is interpreted as printing more money, because when the government is openly buying bonds from the market, it's basically getting pieces of paper and giving you cash.
Yeah.
So this injects more liquidity into the economy, which supports economic growth. But then it has the overall impact of raising inflation. So for Japan, they've been doing this in order to fight deflation and raise inflation. And this has been a battle of 2 decades.
Yeah.
But now they're almost getting to that area. So the problem is when you keep doing this over and over again, the currency keeps losing value.
Yeah.
So right now, with interest rates at negative 0.1% officially in Japan, people are able to borrow at very low interest rates in Japan and then invest this money in US equities as well as US bonds that are currently yielding 5%. So the US 10-year yield is 5%, and you can borrow from Japan and invest in US. Yeah. So this creates a direct flow where now there is excess Japanese yen and a scarcity of dollars, which keeps on weakening the currency pair. So going forward, I would be expecting the USDN to break above 150 unless there is a very, very strong intervention by the Bank of Japan.
I was listening to something, reading some rumors.
Yeah.
They were looking maybe to open the market.
Yeah.
Or the securities exchange there, regulator there, something like that.
Yeah.
I will definitely retweet this. They were looking to expand the markets to allow people from any other country to invest directly into the economy, so that they sort of buy with, let's say, if you are buying in Kenya shillings or even USD, of course it will be USD at the end of the day, because to find the exchange rate of Kenya shilling there it's 1-to-1, so it doesn't really do much, because I think 1 Japanese yen is almost 1 shilling as well, so or 1.01. But it's actually an interesting developments to watch. I think we'll be watching for the next couple of days or maybe weeks. Maybe what other sector of the economy would you be looking at?
So far, I think there will be some form of rotation. The one sector that I'm very confident about is the oil sector or the energy sector. You remember when Warren Buffett built a position in Occidental Petroleum that surpassed 20%? Yeah, he hasn't left yet. And from what we are seeing is oil prices that were manipulated lower by Biden as he was drawing more and more oil from the SPR. And now Biden has become desperate because oil prices are reasonably going higher and he has not restocked the SPR. Last week, he announced a deal with Venezuela, which has very huge oil reserves. So they removed sanctions on Venezuela just so that they can get more oil. And of course, Venezuela agreed to hold democratic elections next year. But then that basically indicates the kind of tightness we're experiencing in the oil markets. So,
and the demand is still elevated.
Yes. So as long as we continue seeing economies growing, and I know Europe is now beginning to recover, we're expecting GDP data today, and the US GDP could jump to 4.5% in the third quarter. So as long as we see strong economies or recovering economies, and the OPEC plus countries are basically tightening supply, then oil companies are bound to make a big return. I remember 2021, 2022, the best performing sector was the energy sector. 2020, 2021. It's only last year when it was not the best, when tech literally just blew out. But then going into next year, I think energy will be making a much needed recovery. And since the stocks have not performed so badly, they're somewhere around zero, we could be seeing some upside potential going forward.
And probably if situation within Middle East sort of cools down, maybe more people will travel for Christmas. I think this is the second year after COVID where people have tried to explore, you have settled with your finances, you have maybe built up a big savings to now go about and travel.
Actually, the situation in the Middle East is getting worse, and there's a chance it could affect oil supply. There's quite a number of pipelines that go through the Middle East, and as the situation gets worse, it affects supply, which has the upside potential on oil prices. Then there's the issue of winter. With winter comes higher demand for gas And this could also be on the upside, which benefits all companies.
What about the travel sector, the transportation sector?
Transport sector, I think the biggest factor is China. Usually has the largest number of flights.
Yeah.
And I remember once they removed COVID-19 restrictions at the beginning of the year, they had this challenge. They have a requirement for pilots to have at least a certain number of flight hours before they can fly. Mm-hmm. So when they reopened, since the pilots had stayed for long without flying, they were not qualified.
Yeah.
So they have been trying to get this experience until they get back. So by now, I think the industry is resuming strength.
Yeah, based on the numbers of the Golden Week, I think they surpassed the targets.
Yes.
And I think with the Xi Jinping putting in extra cash into the economy, into the banks to sort of jumpstart or rather stimulate the economy, maybe we should be able to see maybe them in regards to oil markets and energy sector also drive some demand on that sector. So definitely I think also the sectors within the travel or transportation should have some good returns or a price action for those who trade on the price. For me, I'll be looking at what the banking sector will do. At least with the yields and everything. And all this talk of interest rates and everything.
Have you seen the massive holes on their bond portfolios?
Yes. So that is what I'm looking at. Maybe some of them are, I think based on Moody's report, they're holding on to 640 billion worth of paper losses. So that's an interesting sector to watch out for. And of course, the defense sector and see, because I think there is some interesting development and rapid, is it WAP? Rapid, where the Defense Act is maybe put in place to ensure rapid production of supplies. So I think I'll be looking onto that for the next couple of and obviously the hotel sector. So those are the sectors I'll be looking at.
Also, don't forget the inaugural speech of the new House Speaker in the US. He basically said he's fully supporting Israel, which could be impactful for the American defense sector. So if they manage to pass any form of spending for Israel, we know that it's not money going to Israel. They are basically buying weapons and equipment from American companies, then selling them there. So in that case, we could also be seeing renewed support for Ukraine, and that would mean more spending in US defense sector. So those talks really stand a chance.
You know, the extension was, I think, 45 days. The one that got the other speaker, and it was just a 45 days extension. It was not actually a proper deal. So I know that will be quite interesting to watch if it will cause some volatility in the markets once the 45 days is almost lapsing. So I would encourage any trader to watch it for that. I think that is very significant for some volatility in the markets. I think we should be able to see how it goes. It should be an interesting end of year after a very interesting start of year.
And the bull market is back in Chelsea.
And Bitcoin.
Of course.
And Bitcoin. But what do you see about Bitcoin, by the way?
I think the current rally is short term.
We have missed to mention that all this ETF talk, are you buying it?
You see, with the ETF, it basically allows, I would say, the corporate America to get an exposure into Bitcoin. So that would create a significant demand in the market. But that significant demand, it's not a number that we can tell this is the number we expect to see going into Bitcoin. However, from the Bitcoin cycle, we know that the halving cycle is next year. So by the time we get to next year, we should be having some good rally. So far, this year, especially in Kenya shilling terms, being up 150%, it basically means that we have already achieved what we wanted with Bitcoin. Like if you have been holding your Bitcoin for the year, you have protected your purchasing power, and hopefully we get to do that next year and every other year.
I'll be watching to see the developments in that space. I think the number of companies, these are not just small cap companies. These are companies invested in critical sectors of the economy, like BlackRock or Vanguard and the rest. Them being actively involved in trying to sort of mainstream the crypto market is something to watch and observe and see if it will divert cash or capital allocation from other sectors and to this sector, because ETF is more or less less risky, less exposure directly for any retail investor, and it allows you to sort of get to learn how it works and follow how the price will move.
For Bitcoin, it's a little bit risky because you are basically getting a third party in between. So if you buy your Bitcoin and store it, there's no counterparty risk. Like if you buy an ETF and the company running the ETF goes down, then it goes down. You know, like what happened with FTX.
Makes sense.
Yeah.
Makes sense. I think that has been very interesting. We'll definitely catch up and after all the earnings report have been done. I've been your host, Jesse, and have yourself a wonderful day. And parting shots.
Thank you to all our listeners. We really appreciate any feedback. And of course, don't forget to share the podcast.
Adios.